I mentioned that in the private sector in many countries, and many of you know this, there's been a move away from the traditional defined benefit plan to what is called generically a defined contribution plan. This is for voluntary savings, or in some cases, as in the Australia Superannuation Fund, not necessarily voluntary. But the idea here is that you work and you put some money aside, your employer maybe puts some money aside, somebody decides how it's invested, and when you retire, you've got whatever it's worth, with which you could buy an annuity, or you could do something else, or you just spend it, probably. So, in other words, notice in the defined benefit plan, the employer presumably puts money in stocks and bonds and whatever, and takes all the risk. The employee has a benefit which is defined. And so all the investment risk is on the employer in a defined benefit plan. Defined contribution plan is exactly the opposite. All the risk is on the employee. The employee can use low-risk investments. In principle, could invest in tips. In principle, maybe if it were possible, could buy an annuity. But the employee now has, remember the defined benefit plan, the employee had no decisions to make, zero. Now, in a defined contribution, you've got to decide how much you save, how you invest it. When you retire, what do you do with the money? Do you invest it? If so, in what? Do you spend it? If so, at what rate? Do you buy an annuity? If so, what kind? Etc. So, you've seen this huge shift from employer-based defined benefit plans to defined contribution plans. This didn't reproduce very well, but if you look at the red, the curve that's going up, that's the number of percentage of workers in the U.S. In the private sector that are in DC plans, defined contribution. The blue is defined benefit, and the green is sum of each. They've got a combination. And the axis runs from 1979 to 2011. So what you see is this dramatic shift. And with this comes many problems, because the average employee doesn't have the foggiest notion what to do about saving and investing, and is generally as bad an economist as the actuaries in the U.S. public sector. Now, how many of you know what an index fund is? Okay, now, the first thing that you learned today, which was really valuable, was the address of gapminder.org. Here's the second thing, and I'm going to take a minute here, and I want to make this really dramatic. There's going to be really deep theory. It's going to involve addition, subtraction, possibly a little multiplication and division. Okay. All right, give me a country, just any country.
Romania.
Romania, okay. We are all the investors in the Romanian, is there a stock? There's a stock exchange in Romania. Yeah. And Romania. I've been to Romania. I think I've been to the stock exchange. Whatever. Okay. You know, just play along. Okay, we collectively have all the money invested in the Romanian stock exchange. Got it? Okay. Now I'm going to divide you. The first three rows here, you know who you are. You're index fund managers, and I'll tell you exactly what you do. Okay, you have 1% of all the money in the room. Okay, you buy 1% of every outstanding shares in every country, every company. Here's a company got 100,000 shares. You buy 1%. You buy 1% of the next company's shares. Okay, okay, and you all do exactly the same thing. You've got 2% of the money. You buy 2% of all the shares. And all the people in the first three rows, that's all you do. Really stupid, really dumb, dull life. And we're going to pay you accordingly, because you don't have to know much. So how many shares are outstanding? Okay? Now, people in rows 4 on back, you are what's called active managers. Okay? Let me tell you what you do. See, you're still in row 3, okay? Back there behind you in row 4. Tell me what you go out and you do research on the companies. You visit the managers, you look at the products, you check with their suppliers, you do research on the latest apps being developed in the Romanian market, et cetera, et cetera. And you figure out which stocks are really good stocks. And you put your money in those, and you don't put your money in the really bad stocks. And each of you, and this is interesting, you're smart people, you've got good degrees, you're good at stuff. Okay? And that's what all the people in the rest of the room do. You're all doing this stuff. And you know, you're coming up with different portfolios. And there's some of you in the back row, we're gonna make you hedge fund managers. And what do? You not only buy the stocks that you figure are really good, you actually sell short the ones you think are bad. You borrow them from somebody up here and sell them to somebody else. So if you're right, you make more money. Well, at least you do. Your clients may not. But all the people outside the first 3 rows, you're smart, you work hard, you've got good degrees, you get high salaries, or astronomical if you're in the back row. Okay? Everybody got it? Okay, so that's our world. Okay, a year has passed. Question?
So what is the role of fees here?
We'll get to that. Hang on. So, okay, everybody got that. Okay, a year has passed. Tell me what the return was in the Romanian stock market. Just think of a number.
10%.
10%, okay. A year has passed, the Romanian stock market collectively returned 10%. Okay, now, before fees, before transactions costs, just before costs, what did you make? You? 10%. What did you make?
I would say 7.
No, you can't. You bought 1% of every security.
10%.
You made 10. You have to make 10%. Okay, everybody agree. Everybody in the first 3 rows made 10% before costs. Any questions? Any fights with me on that? Okay, all right. Now, back in the 4th row with the scarf. You're right there. What did you make?
15%.
15%. Okay, smart manager. The lady next to you, what did you make?
15%.
15. Great. Okay, I see somebody back there. I won't tell you who she is, but she made 3%. And there's a guy over here who lost 10%. And there's a hedge fund manager back there that made 30%, and one right next to him that lost 50%. I mean, some of you know Nobel Prize winners have been known to do that. Okay, all right. I digress. What was the return? You use Romania's euros?
No.
Is-
Romanian currency.
Is what?
What's the name?
Romanian currency. Leu.
Lei.
Lei.
Okay. All right. Okay, we'll call them elks. Will that work?
Leu. Lion. Something like that. In English is lion. But
Line. Okay, Leon, like Leon, like in French. Okay. Okay. So Leon. Okay. What did the average Leon, pardon my pronunciation, in the first 3 rows make before costs?
10%.
Now this is tricky. What did the average Leon in the rest of the room make before costs?
Less than 9.5.
Before costs.
Before the 10%.
Okay, everybody got that? Now, what do these guys charge? Next to nothing. They don't know anything, they don't do much. You know, they don't trade very often, just new issues and maybe redemptions. So we don't pay them much. Yeah, we're paying like a fraction of 1% a year of the assets. What do these folks, except the back row, what do they charge?
2%.
1%, 2% a year of the assets. Of the assets. What do the people in the back row charge? Oh, man. Okay, so now, and this is just the bottom line of a little tiny paper I wrote years ago called The Arithmetic of Investment Management, of Active Management, whatever it's called. I don't know. So after costs, what can you say about the average actively managed dollar vis-a-vis the average indexed dollar?
Less.
Got to be lower. So the average investor in the back part of the room will do worse after costs than the index fund investor. Period. End of discussion. Simple arithmetic. No fancy equilibrium theory. No mean variance optimization. No equilibrium. None of that. Simple arithmetic. Okay. And that's a really profound issue. Now, what I've got here is a slide with some things, and I'm going to skip them. They're from an article I just published. But what this basically says is, if you're saving for your retirement and putting money in every year for, say, like 30 years, okay, and you put it in an index fund, and your friend in the back part of the room puts their money in a typically actively managed stock fund in the U.S., you're going to live 20% better throughout your entire retirement than your friend is. 20%. That's a huge difference. When you realize that most people are going to have trouble living in retirement on what they have saved, you realize that 20% hit can make a huge difference. So the basic mantra of invest, sometimes called passive investment, rather than active, these are not small numbers. People tend to say, well, what's 1% fee? Big deal, it's only 1%. It's 1% of everything, and it's 1% of everything every year. Or another way of saying it is, well, it's 1% of the total actual return on a portfolio, which is probably only 5 or 6%, so it's 1 out of 5. These are huge hits. So unless you think that you've got somebody in the rest of this room that's not only smart, but a lot smarter than the average intelligence in the back of the room, then you're going to be a loser. And that's stupid. Yes?
So would you say that since defined benefit plans have sort of given way to defined contribution plans, the way to sort of secure yourself is to invest in index funds, and so does that still, investing in index funds, does it give you the same benefits net as the defined benefit plan would?
Oh, I'm sorry. I can't answer abstractly because it depends on the terms. I mean, generally, the typical person investing in a defined contribution plan, understanding that they get to choose within limits how much they actually save, probably will end up with benefits that are not quite as great or possibly considerably less than the prior defined benefit plan. And that's a big problem. But at least if you're in one, first of all, you better put a lot of savings in. You better have some notion as to how much you should be putting in. And typically, you have to choose an investment vehicle from a list that the employer has given you. You can't just go out and put it in any old thing. But we're seeing employers increasingly providing some index type investments. But it's a big problem. And I have a graph here, which I just found this. I have no notion. It says through 1850 to 2009, but it seems to go through 2011. So, and this is from the National Bureau of Economic Research, so it's got to be true. But this is a measure, and there are other measures. The financial sector as a percentage of U.S. gross domestic product. And look what's been happening. Massive amounts of resources sucked out of the real economy to the financial sector. Now, I think financial instruments can be just great. They can help reallocate risk. They can do all kinds of wonderful things. But I think any careful observer would say, just a minute, that the typical story, many of you heard, when you talk about a commodity futures contract, where you're making a contract based on the price of corn next year, and the typical story is, what a great idea, I'm a farmer, I've planted my corn, and I'm really worried that next year when it comes up, the price is going to be low. So I'm exposed to that risk. You're a processor, you're going to buy corn next year to make whatever you make out of corn, and you're worried that next year the price is going to be too high. And so you're facing a lot of risk. Voila, the Chicago Commodities Exchange comes along and says, I'll tell you what, I'll let you guys make a deal so that you can, in effect, bet on the price of corn next year so you can both fix your price. And the argument is, here's a financial instrument to allow people to reduce their pre-existing risk. It's what's called, classically, a hedge. You have a risk, you enter into a transaction which will reduce or possibly even eliminate that risk. And that's great, and financial commodity futures can do that. But they can also allow me to do a deal with him. I don't raise corn, I don't process corn, I don't even eat corn, neither does he. But I'm convinced the price of corn is going up, and he's convinced for whatever reason it's going down. So we make a bet. And that contract is no different in kind from two people betting on the outcome of a soccer match, or what you would call football in the rest of the world. And so lots and lots of financial contracts may have a possible use for hedging, but they also can be, in large part, are used for betting. And I'm not saying betting is bad. Betting, I'd rather do my betting where I can watch horses go around the track, or have somebody bring me drinks while I'm at the table. But I think when you look at this kind of trend, you have to say, wait a minute. And we all know that there are externalities. When there become bets that are really large, and a risk manifests itself, and all of a sudden taxpayers have to bail out one or both of the parties that were engaged in some of the activity. So, I don't want you to think that because I study these things, I think they are uniformly good for mankind and there should be unfettered competition and ability to create abstract and obtuse and abstruse financial instruments. I sometimes say it's sort of like you don't castigate a sociologist that studies prostitution. Yes?
At least in the U.S., as you had mentioned, many of the large pension funds currently are underfunded. And ironically, one of the ways they're trying to cope with it is by increasingly entering into more and more exotic investments, such as hedge funds and private equity. I think the allocation for them has gone from 3% of their massive portfolios to 15%. When you talk to them, or when you interact with the investors, do you feel like, is your observation that they're reasonably informed about what they're doing, since this is a very artificial and short-sighted way of hoping for decent returns, or is this just massive burning that we'll regret even more in 5 to 10 years?
There are a couple of things going on. First of all, the traditional corporate defined benefit plans are beginning to go away, as we've said, and we're seeing a lot of them defeasing and actually going towards fixed income instruments to actually buy assets that match the liabilities. But in the public sector, in the endowment sector, and foundation sector, you're certainly seeing this move to what's called generically the Yale model, developed by others, but also by David Swenson at Yale, which is to buy a lot of illiquid assets, private equity, some kinds of hedge funds, venture capital, real estate, commodities, what have you. And the argument that probably may be valid is there may be a premium for illiquidity. In other words, you and I may want liquidity, So we will shun an investment where we can't get our money back for 10 years, like some private equity deals. And those may be priced to actually have a higher return given the risk because of the illiquidity. And some very recent studies are suggesting that there may be something to that argument. It could be as high as 300 basis points a year, perhaps. I think that's quite concerning, and I'm not totally persuaded, but some very good economists have done an awful lot of work, careful work with the data, and seem to be finding something. Does that mean it'll be the case in the future? I don't know. I mean, the trouble with security markets is you torture the data until it confesses of something, and then you say, well, here's a system that would have worked in the past. And then you go out and try to invest following the system. And what happens? It doesn't work. Why doesn't it work? Well, perhaps because it was just sheer chance that it worked in the past. Or maybe there was something in the market wasn't processing information appropriately. But now that you're out there and you've told your friends, the market will process it efficiently and it won't work anymore. And I'm old enough to have seen just a host of systems which worked beautifully in the back test. And people put real money in them, and they didn't work. And so I've become very skeptical. A friend of mine in the industry, once said, well, I've never bet a back test that I didn't like, because nobody will come to you and say, look, I've got this system I'm going to use to invest, and I've looked to see what would have happened if I tried it in the last 20 years, and I would have lost a lot of money. Please give me your money and I can invest it. They will come and say, here's a system, look, this has a t-stat of 8, in the past data, it would have worked just beautifully. And then you say, well, how did you come up with this? And they say, well, I tried 300 different things, and this is the one that had the t-stat of 8. So I'm very skeptical. I'm sort of, my money's with the folks at the front of the room here. Yes?
I have a question. Given everything that you told about unfunded funds, do you think it can make sense to make Social Security voluntary? So
I'm sorry, I missed the
to make
keyword.
it voluntary, like not mandatory.
Oh.
If I want, I would say, okay, I don't need any Social Security payment, give me 100% of my wage, and I will do whatever I want, and I will take care of myself when I get older. Like, what do you think about it?
Okay, so let me just make sure I understand. So the question is, to what extent should you let people decide how much they should save for their retirement? So there are a couple of things. First, most social systems are not truly saving systems in the sense that what I put in is what I get out with earnings. Because if I'm on the lower end of the income distribution, I will typically get out more than what I put in. And if you're at the upper end, you'll typically get less. So they are intentionally redistributive. And so if you go away from that towards a system where you get out what you put in, you've lost the ability to move money from the poorer parts of the society to the richer. And so I was taught when I first started taking economics to always try to differentiate between issues of equity, what is just in a just world, in a decent world, and efficiency. How can you efficiently allocate resources? So in principle, I was taught as an economist, I'm not an expert in what is right and just and equitable. So I can probably punt on the question of whether or not we ought to take that away. But I will say I personally am very much inclined towards at least the level of the kind of social programs we saw in the graph. But again, you may not be, and there aren't economic principles for that. If you think that he should get the same amount that she gets, And I think that, if she works harder, she should get more than he gets. That's, economics, I was taught, has nothing to say about that. You can talk to sociologists or psychologists or religious people. The other thing I would say is our experience, and I should say full disclosure, I helped start a company that actually helps people make those decisions within their defined contribution plans, helps the employees. And because left on their own, they make terrible decisions. They don't save enough, they buy the most expensive funds that have no indication that they're going to do better. They retire, they get the money, and they spend it. So I think there has to be some sort of paternalistic societal influence in this arena. And I think most of us would agree with that. The question is, where do you draw the line? How much do you force people to do one way or the other, and how much do you let them do? And then there's a whole middle ground exemplified by Dick Thaler, Shlomo Benartzi, some of the behavioral economists who've been working in this area for years, in what they call a nudge, which you say, well, and here's the statistic. If you join my company and I say, I have this great defined contribution plan, and if you put money in, I'll put in up to 3% of your salary, I'll match you. And I really think you ought to put in 8% of your salary. And if I say, okay, if you want to do this, just here's a piece of paper, you sign it, and say how much you want to do, and you're in. And if you don't sign it, you're not in. Turns out, lots of people don't sign the paper. So Dick and Shlomo's idea was, I'll tell you what, I hand you the piece of paper and I say, by the way, here's the deal, and if you don't sign the piece of paper, you're in. If you do sign it, then you can be out. It's called opt out, rather than opt in. It makes a huge difference. You get so many more of your new employees in the plan. And then they have another cute little wrinkle. I'll tell you what, you really ought to be saving 10% of your salary. Oh man, I can't do that. I've got a new kid, etc. Fine. How about 5%? Yeah, I can do that. I'll tell you what, here's a piece of paper. If you get a raise, we'll put half the raise into your savings up until you get to 8%, or whatever the number may be. And then, it's much easier to commit future money, especially when it's money that when you're going to be richer, than it is to commit money today. And so people say, yeah, I'll do that. And then you say, and by the way, if you don't sign this piece of paper, that's what's going to happen. So you get a double whammy. So there's this whole idea that you don't force people to do things that you think is in their best interests, but you sure encourage them. And that has been shown to make really big differences. I'm I guess what we now call ourselves financial economists. When I started, there was no such thing. I was just an economist, but I am one of a tribe that tends to focus on issues having to do with financing. And what I'm going to talk about today, and what we're going to talk about today, is financing retirement. And you see the word aging. And I spent a long time agonizing over that word. It turns out this is the British spelling of aging. The American spelling has no E in it, which to me looks like Aggie. And so I'm using the British spelling. But the focus here is societies, as we'll see, pretty much around the world, are getting older, which is in many ways a good thing, but in some ways perhaps not such a good thing. So I want to concentrate this afternoon on the issues that are associated with that huge tectonic shift in societies. And I'll be using some financial theory, and since I think some of you mercifully have not been exposed to some of this theory, I'll try to make it reasonably comprehensible and when we get to it. And for those of you who are, and how many, I'll just do it in my first poll. How many think you know what a pricing kernel is? Okay, well, you're excused. You can go to the pool. And the rest of us, are gonna talk at some length about that. Good. Okay. Let me start, and I should say that we spent the last half hour trying to get my Macintosh happy with the Iseo projector, and I think we've been reasonably successful. What I couldn't do, and I might try again, is to get on the internet now that you're all in here and you've turned all your iPhones off. So we'll see if maybe I can get, there's a site that I think if you don't know about it, you should know about it, and I'd like to show it to you, but if not, I've got some pictures. Okay, so here's the issue. These are cross-section data, but they're adequate to tell the time series data, the life cycle story that I'm sure you all know well and fully understand. These are units of income and expenditures in the U.S. A few years ago, but the point is clear. When you're young, you don't earn much and you don't spend a whole lot. As you get older, you earn more and you spend more, but mercifully, hopefully, you spend less than you earn, because there's going to come a time when you get old in which you're going to earn considerably less than you need to spend, and certainly less than you want to spend. So that's the basic life cycle story. Somehow or other, you've got to take the resources from that middle period when you are earning more than you are spending, or should be earning more than you are spending, and transfer those resources forward to the older age periods. And that's something that financial systems are supposed to be good at. They're certainly not perfect, as we'll see, and as you know well, but that's the issue. And that can be done by the society, it can be done by an individual, it can be done by a combination of the two. And the trick is to try to figure out a reasonable way to accomplish that in an efficient manner with as little risk as you can possibly deal with. And you'll see that that's a real challenge, and it's a challenge that's getting, if anything, bigger. So let me start with demographics. I'm not a demographer, so I won't be able to answer your questions if you go very deep. But here's the thing. Now this is the site. How many of you have ever been to the site gapminder.org? Yay, good. Okay, well, those of you who raised your hands, how many of you put your hands up again? Put up the other hand if you think everybody in the room should know about this site. Those of you who've been there. Yes. It's just fabulous. This guy and his family up in Sweden have created this site. It's got scads of data, country by country, time series, and you can graph it in the most amazing ways. You can also download it. And what's astounding is he has figured out a way to show up to 7 different things in one graph. And I don't know if you want to, let's talk among yourselves. Let me see if I can possibly get on the internet. I suspect I can't, but I would like to download this just because it's a sort of a ooh experience. Let's see if I get lucky. No. And it thinks it's on wireless, so okay, forget that. Okay, back to the slides. Okay, so here's the example, an example. What I'm showing here on the horizontal axis is income per person, GDP per capita, real GDP, inflation adjusted. And the way this software works, for a given year, you get a dot for each country, and the country's color-coded so you know what region it's in. And the size of the dot in this particular version is a function of the, what is it here? It's of the income, I think, yes. And then the vertical axis is whatever you want it to be. Indeed, you can change all the axes, change from log to linear, et cetera, et cetera. But let's just focus on the substance, and it's this strange, snaky-looking thing. And that is the income per capita, real income on the horizontal axis, log scale, and life expectancy on the vertical axis. That's life expectancy at birth. And what you see, and if we were running this in real time, it would all go forward and the little snake would crawl up the page. What you see is that life expectancy at birth in the US back in the 1800s was somewhere around 40, and it was pretty much 40 year after year after year. And then, of course, we got richer, moved to the right, and people started living longer, moving up. And you probably can't see them very well, but all those other little dots are other countries. And with the software, you can choose a country, you can make it have a little trail like this. And what's astounding is you see country after country after country, life expectancy getting longer and longer and longer. And look at that number at the end, 80 years plus. And if you make it to 65, life expectancy in the US is another 20 years, give or take, depending on whether you're male or female, and of course, depending on how healthy you are, etc. But average people, if they retire at 65, are going to live and need to be fed for, on average, 20 years. Some of them a lot more, some of them somewhat less. And everywhere you look, you see this increase in life expectancy. Now, why is that? Presumably a lot of it's technology. Medicine is much better at keeping people alive than before. People are somewhat better at keeping themselves alive than before. Thus far, McDonald's has not caught up and diminished this life expectancy, but they're still trying. So factor number one, people living longer, virtually everywhere. Factor number two, on the vertical axis now, I have fertility. What is that? Number of children born per woman. Okay? So you see in the 1800s in the US, 7 children per woman. And as you see as time goes forward, of course, everybody gets richer. You see a dip here. Anybody guess what that is? World War II. A lot of men were off at war. Some men didn't come back from war. And so there was this pent-up demand for children, manifested itself after the war. That's the so-called, what do we call that? That's the baby boom. But you see, once we sort of got that over, down we went again. A little upturn. And what's amazing is, again, if you look country after country after country, you see this humongous fall in fertility. Whereas the average worldwide, what would you guess? How many children per woman? Okay, we'll tell you that you can raise your hands. How many say 5 or more? 4 or more? 3 or more? 2 or more? Less than 2? Okay, it's about 2, give or take. And there's a if you go to the Pathfinder site, you can find a bunch of videos, and there was one that the guy who runs it did at a TED conference, which are disgusting things if you know about them, but sort of inspirational factoids. But he did a very nice one, and he cut all this by major religion, Islam, Christian, Eastern, and his basic point, and he had the little graphs moving here, moving there, is that it's really not correlated with religion. Technology makes it possible to have fewer children. People get richer. And one of the things he pointed out, which I hadn't thought of, is that in some sense, back in the day, if you wanted to have 2 children to support you, if you made it to old age, you better have 4 or 5 or 6, because lots of them aren't going to get there. Now, with life expectancy much better, in a sense, you don't need to have as many to begin with. And he at least argues that that's part of it. Whatever, you've got these 2 forces almost everywhere. Fewer children, older people, longer lives. And that is, at least demographically and financially and economically, kind of a recipe for disaster. And let me show you how that plays out. This is something called a population pyramid. As you see, it's not quite a pyramid, because if you look at the bottom, what this is, it's sort of every demographer's standard tool. Each of the bars is a 5-year age range, 0 to 4 at the bottom, 100 plus at the top, but there's almost nobody there. This is the United States in 1980, because this was done back in the days when we made these distinctions. There's a female side and a male side, but the point is that it is sort of like a pyramid. Now, it isn't quite like a pyramid. You'll notice that if it were a pyramid, it would go all the way down to the base, and you see there's a little sort of a notch out of it in 1980, and that again is representing the baby boom moving through. But historically, when demographers made these graphs, they looked like pyramids. A whole bunch of people at the bottom, not very many people at the top. Which is very nice if you're at the top, because it means there are a lot of people who are working their tails off to support you. Okay? So that's 1980. By the way, this is from the U.S. Census Department. It's a fussy site, but you can create a zillion of these if you're determined. Okay, here's the U.S. again in 2013. Look what's happened. Go back. Whoops. It's now more like a rectangle with a pyramid on top, or a triangle, if you will. Here's the projection to 2050. You might say, well, it's a projection, come on. But it's not that hard to project how many people are going to be alive in 2050 who will be age 50 or over. So it's not a difficult projection, at least the upper ends. And look what it looks like. And the Gapminder people talk about this as filling out. You filled out the bottom, and it's still going to take us a while to get there. So here's a kind of a conjunction of facts that's interesting. By and large, you're going to get, from here on, about 2 children per woman. Now let me ask you another question. Take that as a premise. How many people do you think there are in the world now? 7-some billion, right? Okay, in 50 years, say, or when it hits some sort of steady state, how many do you think there'll be?
12.
9, 12, 8. His answer is 10. And that's because, you know, you got to sort of fill out this thing over the coming years till you get to some sort of steady state that will look something like this. And from an economic standpoint, the critical thing about that is how many people that we think of now, typically as of retirement age, there will be vis-a-vis the people that we think of now as working age. So here's a graph. Did you get the readings? Okay, I should tell you about that. Bob Solo is putting together a book of pieces that a bunch of us have written that's targeted more or less for really smart high school seniors or fairly smart college freshmen and sophomores. And what I handed out was a piece that I wrote for that, which has this graph. So I hope I didn't insult you, but it's a relatively compact place where you can find some of the things we'll talk about today. And this graph, which is from a consulting firm, and I think is probably well founded, talks about what is typically called the old age support ratio. And that's very simple. It's people 65 and over divided by people 20 to 64, on the grounds that those are sort of what we have traditionally thought of as retirement age people and working age people. You know, some of you might argue that in modern societies you don't at least earn money. You may work, but you don't earn much money until you're older than 20. And we will certainly see that the idea that you retire at 65 is something we're all going to, pretty much, you're going to have to get over. But taking that as what it is, the right-hand side of each of these bars is what it was in 2008. The darker shaded part is what it's projected to be in 2050. And their countries arrayed. For some reason there are two panels, I guess because they didn't fit on the original pages. For some reason they've got them merging down at the front, at the bottom. But what you see is, let's just take the OECD, if you can see it's in red. The OECD in 2008, you had somewhat over 4 working people for every old person. Projected 2050, somewhat over 2. And you see in country after country after country, this huge tectonic, as I said before, shift in terms of the ratio of currently thought of as working age people to currently thought of as retired / old people. Some of us take umbrage at thinking that over 65 is old. So this is a big deal, and it's everywhere, and it's going to just get worse. Here's a graph I did for a talk 3 years ago, I guess, in China. Those of you who are from China or from the US or study one or the other know there's this kind of contention. The US is borrowing all this money and China's loaning it to us, and that makes us enemies. So there's this competition, China versus the US. And here's a graph, and for this graph I just used 3 of these projections. 2010, 2030, 2050 on the horizontal axis. And this is basically, it's just that same ratio expressed somewhat differently. That's as a percentage of the total population. So this is 65 and over as a percent of the total population. And if you start at the 2010, you see that there were more old people proportionately in the US than in China. And in 2030, it was projected to be pretty much the same. But in 2050, huge gap. And anybody know why that is? Or one of the main reasons? It's a one-child policy. They talk in China about 4-2-1. You know, you've got, you look at the pattern, 1 child, 2 parents, or grandparents. In any event, and one of the things that people talk about a lot is, man, people in the US just don't save much, and they're saving like crazy in China. And this graph says, well, why are they saving? A, because they can. Many old people to support. And B, because they've got to, because they're going to have a whole lot of old people to support. So you can explain a lot of things that perhaps people who aren't familiar with economics might think are strange or reflect cultural differences. They probably do reflect cultural differences and many, many other aspects. But the demographic differences between these 2 countries are really profound. So there's our issue. how are we going to organize society, help people arrange so that people save enough when they're working to support themselves when they're old? Or if you think about it cross-sectionally, how are we going to get the working people to forego enough consumption so we can transfer those resources to the old people so they can consume? So you can think about it as a time series issue or as a cross-sectional issue, but it's a big, big issue. So here's a graph I found in a recent report. It back referenced this. This is from a World Bank study done some while ago, and they, in World Bank parlance, came up with a multi-pillar approach, and they even have the little pillars here, so you can see it. But let's take a look at that. I'll read them to you because it's hard to see in the back. Pillar 0, a basic public pension that provides a minimal level of protection. So this is the kind of social policy no one will starve in old age. Pillar, that was 0 for some reason. Pillar 1, a public, mandatory, and contributory system linked to earnings. This is some sort of a system, and maybe you've got a public policy which has both 0 and 1 in one package, but it says, by the way, you've also got to save an additional amount, and that amount, at least in units, dollars, euros, will be larger the more you earn. But you got to do it. So it's not a volition at all. And then the next pillar, a private, mandatory, and fully funded system. Okay, let's parse that. It may be private, but it's mandatory, which makes it seem sort of public, at least to me. But the idea is it's a system which is not just the government will take money away and then give you money when you're old. There's some notion here in which you will take money out of your paycheck and you will put it in some sort of investment. And the fully funded means you will put enough in to cover whatever benefits you think you're going to get later on by having done that. And we'll see this idea of fully funded becomes a very important issue in some pension systems in some parts of the world. Pillar 3, now we're finally getting voluntary. It's voluntary, yeah, you want to save, fine. But again, if you save, it goes somewhere, and what you get is whatever that savings is worth when you retire. And then they've got a pillar 4, which merits, for some reason, a different color. Basically, this is what in the US we would call Medicaid, which is one of our public policy systems, which says, if somebody is very sick and has no money, you will put them in some place and give them medical care and feed them. So again, that's a bit of an overkill and pillar. But you see the sort of the range of ideas and the range of systems. And in most countries, you see some sort of an amalgam of these kinds of programs. We'll talk about it. Now, a consulting firm, the Mercer firm, has, I guess, for a few years done a study with the Australian superannuation system, which is a system we'll maybe talk about. And I thought this was kind of interesting, since you're from all over the place. I thought you might like to know what kind of grade your country gets. So this is their recent study. They looked at all kinds of things, had various kinds of weighting systems and grades and scoring systems. And I wouldn't say that it's perfect, but it's at least interesting. And they assign letter grades. And so letter A, it's first class, it's a robust retirement system that delivers good benefits, is sustainable, and has a high level of integrity. Sounds good to me. And E, which is the lowest grade, they don't have any. D, which is the lowest grade, they gave a system that has some desirable features, but major weaknesses, omissions, without improvements, its efficiency and sustainability are in doubt. Okay, so I want you to form your own opinion as to where your country is going to rank. Okay, are you ready? Are you ready? Okay. You probably can't see this, but I don't think I have. We'll have to do what we can do. But who got the A? Denmark. That's it. Okay. And if you look at the color coding here, the good guys are, let's see, I put the colors in order. So the red, it's a little washed here, is A, and then dark green is next. So dark greens, Australia is pretty good. They're the client for the study. Of course they're going to do well. Sweden is good. Switzerland is good. Canada's good. And then you get down to the dark blues. United Kingdom is good. Chile is good. Chile did some pension reform a long time ago. And they did it, in my opinion, really badly, but they've made it better over time. And then, the light blue, which, is, what is it? That's the light blue. Let's see what light blue says. Has some good features, but major risks, shortcomings should be addressed. Without this, its efficacy or long-term sustainability can be questioned. And who's light blue? Well, the U.S., among others. And Poland and Germany. They don't cover all the countries, so you may have gotten off the hook. And who gets the bad grades? It's India, it's China, it's Korea, it's Japan, of all places. So it's not just a function of per capita income. So take that for what it's worth. We paid nothing for it, so you can consider it worth nothing. But I think it's interesting. Question?
Just to clarify, maybe I can't read it from back here, but is this just state-sponsored pensions, or?
No, this purports to be the whole schmear.
So including
Mhm.
person defined contributions?
Yeah. And again, I tried reading through the full report, and it had many, many, many things. Most of them qualitative, to which they assigned scores and they took weighted averages. So I mean, I would not over stress its importance, but I think it's interesting.
And something like home equity, which many Americans mentally account for as retirement, is that also?
I don't believe that was included. Again, I don't hold me to that. You can get it online. And here's something else that they reproduced, and again, reading through in the detail, you can get a little different take, but I know you can't see it from anything other than the back rows, but what this is, the left-hand part of each bar is purportedly the equity, as in stocks. Investments that are being used as you look across the system in the country. The next bar to the right, the blue, is treasury bills, bonds, if you will, fixed income. And then the little red, which in some cases isn't so little, is cash and deposits. So money market, funds, demand deposits, and then other, and then they try later to break the other down, because there is some real estate, but I don't believe it's home ownership. I think it's real estate and commercial real estate and investment strategies, say, in insurance companies. But I guess the thing I was struck with this, guess who's got the most equity? Who would you guess?
Yeah.
Those Americans. They love that stuff. Okay? And then you get down here to the Czech Republic just as well. They don't these days. So I'll just read you the countries. At the top, United States, Finland, Australia, Chile, Belgium, Poland, Norway, Canada, Austria, Turkey. Then you get down Portugal on the bottom. The bottom is Korea, Czech, Slovak, Slovenia, Greece. et cetera, et cetera. They may have a lot of bonds, but we know what kind of bonds they probably are, don't we? So, but perhaps maybe the most important thing impressionistically is, at least if there is the right solution as to how money should be invested in for this kind of retirement saving, there sure is an agreement country by country as to what it is. You got a huge range of alternatives. Okay? Okay, so we're going to start, I'm not going to try the pillar analogy, but let's start looking at some of the pieces. Starting with social systems. And in the US, we call it Social Security. It's called different things in different countries. You'll excuse me if I tend to say Social Security because that's what I'm used to, and I'll look at that. But here's a graph. It's a little out of date. It's from an earlier study by the same consulting firm. I think it's reasonably accurate. I found it, some of it, surprising. What is it? On the horizontal axis, you've got the pre-retirement salary. That is what you're making while you're working. Up, well, actually, let me restate that. What you're making just before you retire as a percentage of the average earnings in the country. So if you look at down about 1, 2, 3, 4, 1.0, those are the people who are making the average earnings in the society when they retire. So those are, quote, average people. And if you go over here to the far right, which is 2.6, those are the people who are making a lot more, 2.6 times the average. Okay, and on the left, by the way, is 0.5, so those are people making only half the average wage at retirement. The vertical axis is what you get in the first year when you retire, divided by what you earned in the last year before you retired, which in this business is known as the replacement rate. And there's a sort of a received wisdom that maybe that ought to be 70 or 80%. Because when you retire, you don't have to drive to work, you don't have to get a lot of good clothes, et cetera, et cetera. But I mean, that's just a number that financial planners like to use. And what you see is, with one notable exception, except for the very poorest, the social program, the mandatory program, does not give you that replacement rate. And one thing you'll notice is, except again, we'll talk about the one at the top in a minute, you'll notice they tend to go downhill. So generally, the people who are earning more get more dollars from the social system, but they get a smaller percentage of their final pay. And most of these programs, you have to put money in. It's also true that people who are in the higher income categories put more in as a percent of their pay in most of these systems. So these systems, typically by design, are regressive. I'm sorry, are progressive. It depends on how the sign works. They're progressive. They are intentionally redistributive. So for the average participant, it may well be that what you get out is worth what you put in. But for those at the lower end, you get more out relative to what you put in. For those at the upper end, you get less out relative to what you put in. So they're not just typically a savings vehicle that are just a mandatory version of a typical program where you save, you get out what you put in plus earnings. Okay. And I was surprised to see that these are not as different. I must admit, I've thought for years that, especially in Europe, the social programs were more generous than the US program, but they're not heavily so. The US here is the red, and it's kind of in the middle. Okay, those of you in the back of the room can't see. Who do you think is up there at the top?
Italy.
Yes, Italy. Yeah. Which probably explains a lot. Now, Italy takes a huge chunk out of people's incomes to fund this program. So it's not entirely, a tax on the rich, totally to pay the poor. But it's pretty, was at least in 2010. And as you know, there are strong pressures in a lot of countries, especially in the EU, to change at least the public employees' versions. And there are some pressures, I suppose, on these. Now, there's a lot of chatter in the U.S. about Social Security. It's been a big point of contention between our two major parties, it seems, for decades. And here are some numbers just to give you a sense of what you hear and what may be germane. People say Social Security is underfunded. And here's a number. If you look at the latest report, which is just out, 21.6 trillion. There's a calculation that has been made by the trustees of the system that if we wanted to put enough money in the system so that the present value of all the future payouts, withdrawals, would equal the present value of all the future inflows, we'd need to add 21 trillion. And for those of you who don't know the numbers, the GDP of the entire country is less than that, about 16. So that's a lot of money. And people say, well, this is an underfunded system. And there are other people who say, well, it's worse than that. If you look to see what's in the vault, what are they? Anybody know what's in the vault? What kind of investments? What kind of security? If you open the Social Security vault in the U.S., said, okay, you've got a bunch of securities in there. What do you think they are?
T-bills.
They're all U.S. government bonds of one sort or another, yeah. So some people say that doesn't even count. It's worse than this. But I don't want to get in that. But here are three other numbers that you virtually never read about because they're buried back in page 200 and some. If you take the present value of the cost for the future participants, okay, so you say, okay, we've got these people whose names we know, but if you take all the people who are coming in the program from now on, which means people who are less than 15 years old now, and all the people who will be born forever and ever thereafter, you might say, well, that should be an infinite number, but these are discounted, so through the magic of discounting, you get finite numbers. What's that number? 46 trillion. Whoa, okay. But if you also say, well, how much money will all those people pay in under the current rules over the infinite horizon? It turns out it's about the same number. Which means, at least subject to one caveat, the problem with Social Security, and this is pretty much, I suspect, the case in many countries, is not that the system is broken. If you were to adopt it de novo going forward, subject to a caveat, it would be fine. The problem is the people who are in it now. And what has happened with this system, as with, I know, with some systems elsewhere in the world, legislators have said, well, let's make the deal better. Let's raise the benefit formula. And they've forgotten to put in the money to cover those enhanced benefits. We're going to see that happening in public government, state, and local pension funds in the U.S. in a minute. So that's the good news, or bad as you take it. But here's the caveat. The U.S. Social Security Administration uses a discount rate equal to a real interest rate of 2.9%. That is, they assume that $1 a year from now is worth 1 over 1.029 times as much as $1 today. A real dollar, adjusted for inflation. And they do that on the grounds that, well, look, if we take the last period, these are their numbers, not mine, from 1970 to 1980, if you take the rate of return on a US Treasury bill and subtract the realized inflation, you've got a very, very low real rate of return, about a third of 1%. That means you give up a unit of consumption today, a year from now, you get just a tad more. On the other hand, in the next decade, that realized real rate was over 6%. And in the next decade, it was over 4. And from 2010 to 2010, it was 2.11. And so they said, well, let's take the whole period. We get 3.23. We'll mess around with some other numbers and we'll use 2.9. And this turns out to be a critical number. When you think about that whole savings path over a lifetime, the most critical thing you have to think about is the real rate of return, riskless real rate of return. If you forego consumption today, how much consumption can you reasonably expect to get by investing the money in something that is as safe as you can get? Then we can talk about equities and all that other kind of stuff. We need to think about that. And the U.S. Treasury Department says when you think about that, when we think about that, we think 2.9. Anybody guess? Well, how many of you know what a Treasury inflation protected security is? I think I do. Okay. Well, you have. There's no reason why you should, unless you live in the U.S. As you can see, the problem with trying to estimate the future real rate of return is that if you take the realized rate of return when you buy something that's a nominal instrument and wait to see what inflation is, it's all over the map. You can't lock in a real rate of return by buying a nominal government bond of any duration. But in many countries, there are things that in the U.S. we call an inflation-protected security. In the U.S. they're called index-linked gilts, I think. Is that right? And governments issue them fairly frequently these days. What this is a bond whose payments is indexed for inflation. So if inflation is high, they just pay you more. If it's low, they pay you less. So in principle, the real rate of return on that instrument is the riskless real rate if you assume that that government security is not subject to default risk. That's as close as you're going to come to a forward-looking real rate of return. And I did these slides originally a few weeks ago, and I had a slide you're going to see next. But I thought I'd better check, so I updated it last night because it's a little less gloomy. But here's what it was yesterday or the day before. This is great. You can go to the U.S. Treasury, give them $1, and they will, in effect, say, great, 5 years from now, we're going to pay you an amount of money that will allow you to buy less than you gave up when you bought this piece of paper. And that discount is going to be something like 0.7% per year. So, 5 years. If you buy a 7-year maturity, it's not quite as bad. As of the 18th, if you buy a 10-year, it's actually a little positive. You might actually get something in higher consumption. 20, it's about 1%. 30, it's a little over. Anybody know why these numbers are so low? And as I said, they were much lower just a few weeks ago.
Because inflation is around 2%, so real rate of return is 1.3% even first.
Okay, but why wouldn't that all be taken into account? I mean, why? I used to teach beginning finance. And the first thing you taught in beginning finance was something called the time value of money. People want things now rather than in the future. So markets have to adjust so that if you sacrifice consumption today, you will get more consumption in the future. And we managed to make about 5 lectures out of that. And say, well, here's how you discount, you compound, et cetera, et cetera. And yet, now, here's a deal where people are willingly sacrificing consumption today to buy one of these things, knowing that they will get less consumption in the future. It's really bizarre. And until not long ago, we didn't ever have to contemplate that when we taught the course. I don't teach it anymore, so I don't know what they're doing. Any guess as to why these rates, what else is low these days? These are real rates. What else is low? Nominal rates. I mean, most 10-year, what are 10-year treasury rates? I don't know, give me a country other than the US. I mean, one that doesn't have a lot of default risk. They're lower than generally expected inflation. So, I mean, you can get a negative expected real return on a nominal instrument. You can get a guaranteed negative real return on one of these puppies. So why is that, do you think?
I'm sorry, I didn't.
No, I'm sorry, we were
But maybe it's an alternative way for pension if people just don't want to join social security system.
Yeah, I mean, I guess I'm looking for something that's a little bit more of a, aha, you're the one who did it, yes. Yeah, no, yes, Mike, sorry.
Oh, is it because of like very so much uncertainty in global markets and volatility that investors look for safe havens, and like U.S. Treasury bills are so much, let's say, riskless, so that they just rush into it?
Yeah, I mean, there's nothing, one presumes that all the other instruments are unattractive, or equally unattractive in their own way. I'm looking for something actually perhaps a little simpler.
QE4?
Yeah, I think, you've got all those central bankers. And, I don't know, I think George left, George Akerlof, I don't want to get in trouble with George. But yeah, the central banks have been pushing rates down, pushing, and these are some of the rates that have been pushed down. And it really raises an issue if you're contemplating saving for consumption in the future. One of my counsels to people is, why don't you buy the boat now? If you want something, buy a consumption good, because it'll cost you more if you buy one of these and plan to buy it in the future. And as I say, these rates have started coming up, as have nominal rates. But it's just hell to sort of think about, how to counsel an individual in terms of saving for retirement. And you'll see, if we get to it, that when I do calculations, I assume this rate is 1%, although I can make it lower. It's just too depressing to make it 0. It's just really depressing.